Alrighty, so I'll do my brief introduction. Everybody, my name is Mike, and I am one of the many tax site managers. So I work at one of the sites that Prepare and Prosper offers services, tax services at. And my role there is to supervise the volunteers and the entire process, make sure everything works the way it's supposed to. I've been doing this job for many years. This is my 11th season now. Um, so thank you, Mary. So I'm going to train you tonight on tax credits. Tonight in Basic D, we're going to talk about the earned income credit, credits for people with dependents, the Minnesota renters credit, and more credits for people with dependents. So reminder, you can access everything on the training site. If you go to Prepare and Prosper's website and click on training site, you can click on basic tax training, and then you'll find the volunteer tax manual, which you'll use all the time in every shift. And spoiler alert, even very experienced volunteers and managers use the volunteer tax manual every shift. You can log into the practice lab. You can link to the practice customer documents. You can find the slides from these presentations if you scroll down a bit. And soon you'll have the recordings of these trainings. For example, as Mary mentioned, this training is being recorded and you'll be able to find it on this site soon. Let's do a brief recap of deductions and tax. So a deduction, we have standard and itemized deductions and new deductions found on pages 114 to 115 of the Prepare and Prosper Tax Manual. A brief reminder what a deduction is. The deduction reduces the adjusted gross income. So we start with AGI, the adjusted gross income. So effectively the income. We subtract the deductions, and the amount that we're left over with is the taxable income, the amount of income that the person's income tax is based on. So deductions reduce their taxable income. Now, if we take the taxable income and multiply it by the tax rate, that tells us how much income tax in a dollar amount that the customer pays that year. Tax is also known as tax liability, which can be lowered by credits. So deductions reduce the total income to the taxable income. We multiply the taxable income by a tax rate, which is a percentage, to arrive at the tax or tax liability, which is a dollar amount. Then we use credits to subtract that dollar amount of the tax liability, how much tax somebody pays in a year. So credits. You know this already, but a reminder that in the top right corner of the slide, you'll see which page in the Prepare and Prosper Volunteer Manual we're on. So if you have your electronic or paper copy of the Volunteer Tax Manual handy, you can follow along by just looking right up here at what page number we're on. So let's talk about credits. The power of tax credits. Tax credits provide an economic boost. The refunds lift millions of people out of poverty each year. They support basic needs. Tax refund dollars flow into local economies when families catch up on bills, pay down debt, and make important purchases. And tax credits offer a savings opportunity. Tax refunds can amount to 30% of a family's incoming funds during the year, and they provide a chance to build emergency or long-term savings. There are two types of tax credits. There are non-refundable credits and there are refundable credits. So a non-refundable tax credit can reduce your tax bill down to $0. So a quick reminder, if the amount of tax that somebody owes in a year is, let's say, $1,000, the non-refundable credit can reduce that $1,000 tax liability all the way down to zero, but not past zero. So if there's more non-refundable credits than tax liability, there's not a refund of that excess. So after that, remaining credit is not refunded. But a refundable credit can get refunded or paid out. So refundable credit, like a non-refundable credit, can reduce the tax liability or tax bill down to $0 and then past $0 into the negative, and that negative balance is paid out as a refund. So Here are some examples of a non-refundable credit and refundable. So non-refundable. Amy qualifies for a child and dependent care credit of $1,200. Her tax liability is $800. So $800 we start with and we subtract $1,200. Because this credit is non-refundable, we have to stop at $0. She'll use the credit to lower her tax bill to $0, but that negative $400 difference is not paid out. If we look at an example of a refundable credit, Julia qualifies for an earned income tax credit of $1,200 with a tax liability of $800. She will use the credit to lower her tax bill to $0, and she will receive the remaining $400 with her refund, within her refund. So in this case, the negative $400 under this refundable column is paid out to the taxpayer. Whereas when it's a non-refundable credit, we can only go as far down as 0, but not negative. So nothing extra, nothing getting paid out. Okay. On page 3 of the IRS intake paperwork, that's the 6-page yellow sheet, Form 13614C, we're going to talk about how to interview customers for these questions. Here are some tips for interviewing customers for tax credits. Make connections to the customer situation. For example, if they don't have dependents, they will not have child care expenses or other items related to dependents. If they're not a homeowner, they will not have items related to being a homeowner, like property taxes, residential energy credits, etc. Ask questions that focus on action. For example, did anyone in the household attend college or university last year? Or did you pay student loans? Notice here the actions. Attend, in this case, attend college or university, and pay student loans. Okay, now we're on to the earned income tax credit. This is page 115 to 118 of the volunteer manual. You'll notice as we go, when we talk about each credit, you'll see different icons up here. This USA icon means that this is a federal tax credit. We also have an icon that you'll see with Minnesota for a Minnesota credit. So this is a federal tax credit. What counts as earned income? So some examples are wages, salaries, tips, net earnings from self-employment, union strike benefits, which are uncommon. What doesn't count? Public benefits like Social Security, SSI, which is supplemental security income, welfare. Other income like unemployment benefits, interest, dividends, retirement income, and non-taxable earned income, such as payroll deductions for dependent care or retirement plans. So more or less, it's income that people earn. They perform some kind of action and earn money for doing that action. There are more details in the volunteer manual because, of course, there are a lot of details to be aware of. So the earned income tax credit, maximum credit. The maximum credit is based on the filing status, the family size, and the income. It can be a lot of money. So for example, we have this chart here that shows the number of qualifying children and the maximum credit amount. So if somebody has 3 or more children, they can get up to $8,046 of tax credit for the earned income tax credit. That's a lot of money. Now, this is the maximum. We don't always see this amount, but the theoretical maximum right here. These two columns here are together. This is talking about the income. Because it's the earned income tax credit, there's a sweet spot of income. So for somebody to receive this maximum $8,046 credit refund for the credit, they need to have 3+ children, so 3 or more children. If they're single or head of household, their income has to be less than $6,155. Or if they're married filing jointly, the income has to be less than $68,675 for both married people combined. So you can review this chart on your own time. Remember, these slides are in the training site.
Mike,
Yes.
was that adjusted gross income? Just curious.
Yes.
Okay.
I believe so. We have a couple minutes, so let's look at the manual. 125. Yes, adjusted gross income.
Thank you.
You're welcome. Okay. So the earned income tax credit calculation curve. We have a chart here that's basically $0 of earned income on the left side and the maximum earned income on the right side. So as people's income increases, the amount of the credit increases until it reaches a plateau. And then as the income continues to increase, eventually the amount of the credit decreases until they reach a point where they don't get the earned income tax credit at all because their income's too high. So we have the phase-in portion where the income increases and the credit increases. We have the maximum earned income tax credit, and then we have the phase out where the income increases and the amount of the credit, the dollar amount of the tax credit decreases. And that's because this tax credit is aimed toward people of lower incomes. Here's an example, a family filing with head of household and two qualifying children. The earned income, if the earned income is $6,000, then the earned income tax credit is $2,410. If their earned income is $20,000, the amount of the tax credit is $7,152. And if their earned income is $45,000, the amount of the tax credit is $2,587. Notice that these colors here correspond with these 3 points up here. So we see the income increasing from left to right in all three of these. We see the amount of the credit increasing and then decreasing. So we have phase in, maximum, and phase out. The nice thing is you don't have to calculate these yourself. TaxSlayer software will calculate it all for you as long as the assumptions going into the credit you have set correctly in the tax software. So why do we learn about the earned income tax credit? The earned income tax credit is calculated automatically, but it's important that you understand why a taxpayer is receiving the earned income tax credit or not. Oh, that's the only point there. Um, and this is very frequent because the rules change for this earned income tax credit from year to year. Not every year, but sometimes you'll have a customer coming in and doing 3 years of tax returns, and they might qualify for the earned income tax credit in some of those years and not in others. And that question is going to come up. Why did I not get this credit this year when I got it last year? And you'll want to have a strong enough knowledge to explain to somebody why they may or may not get the credit. And so the important points here would be um, this is the biggest one right here, explaining the phase in, the maximum earned income tax credit, and the phase out. There are also some other requirements for this tax credit that are in the volunteer manual. Remember, there's very little that you need to memorize because everything's documented in the volunteer tax manual, and there are a lot of other resources for you to use as well at the tax site. Okay, Tina Parker time. We're going to check Tina's tax return. Oh, say that 5 times fast. We're going to find where the earned income tax credit shows up and what the customer's earned income tax credit amount is. So if you recall, you had a little bit of homework between session D and session C and D, or basic B and basic D training, the last training and this training, and that was doing a little bit of data entry in TaxSlayer Practice Lab. If you haven't done it yet, not a big deal because I'll show you. We are going to look at Tina Parker's tax return. So recall that Tina Parker was the practice customer that we looked at in our last training and in both Basic B and in Basic C, I believe. I didn't lead the Basic C training this year, but I did do Basic B, and we looked at Tina Parker. So quick refresh. Tina and two dependents, Terrence and Tasha. So we're going to look at where in the tax return the earned income tax credit shows up. So the first place we see it is the summary page, this really, really nice summary page the tax layer puts on the printed version of the tax return, or in this case, the PDF version of the tax return. We can see right here, Schedule EIC, earned income credit, and right here at the bottom, earned income credit and the amount of it. So Tina received $3,273 of earned income credit. That's a lot of money. That's like approaching 10% of her income. Okay, so let's see all the places. I'm sorry, was there a question? No? Okay. Let's look at all the places on the tax return where the earned income credit shows up. So we have the summary page. We have page 2 of Form 1040. We see right here under payments, the earned income credit. Remember, because credits reduce the tax liability, we calculate the tax liability for Tina, it was 1,868, and then we subtract the credits. So that's why we see credits listed here under payments. So we see earned income credit here on page 2 of Form 1040. We see Schedule EIC. So Schedule EIC talks about the taxpayer and the children, the eligible children. And we see EIC on worksheet A, 2024 EIC reminder in the tax layer practice lab. We're using the 2024 version, not the 2025 version, because the 2025 version of tax layer is not completely updated yet. So we see here a worksheet that goes through the steps to calculate Tina's earned income tax credit of $3,273. We see worksheet B, more information about the earned income credit. And those are the places where we see the earned income credit in Tina's tax return. So we looked at the various places where the earned income tax credit showed up. We saw the summary page of the tax return, page 2 of Form 1040, showing as a payment, the Schedule EIC, and the 2 worksheets. And the amount of the customer's earned income tax credit was $3,273. Okay, let's talk about the rules for the earned income tax credit because they are important to understand, especially when you need to explain why this credit does or doesn't apply. So rules for everyone, that means the taxpayer, the spouse, if married, filing joint, and any children that are part of the earned income tax credit or dependents. So everybody must have valid Social Security numbers. ITIN holders are not eligible. Residents, they must be U.S. citizens or resident aliens all year. Their investment income must be less than $11,950, and none of them can be a qualifying child of another person. So in this case, the dependents that, or the qualifying people that are usually dependents of the taxpayer can be the qualifying child of the taxpayer, but not of anybody else, like another person's tax return. Rules with a qualifying child. So in this case, when we think about Tina Parker, she had 2 qualifying children, Tasha and Terrence, I think her children's names were. So rules with a qualifying child. The qualifying child for the earned income tax credit cannot be used by more than one person for purposes of the earned income tax credit. So in the case of Tina Parker, if the other parent of those 2 children wanted to claim Tasha and Terrence as the qualifying children for earned income tax credit, there would be a conflict because only one of them can, only Tasha or the other parent. And the qualifying child does not need to be claimed as a dependent. So one of the tax benefits retained by the custodial parent, even if non-custodial parent, allowed to claim the child. That means that the parent who claims the child as a dependent on the tax return doesn't necessarily claim that child as a qualifying child for the earned income tax credit, and another person might end up claiming, generally the other parent, but there is some variability that other person can end up claiming that child for the qualifying child for the earned income tax credit. Okay, we've got some qualifying child tests for the earned income tax credit. So there's no test support for gross income and no exception to the residency test, but we have age, relationship, residence, and joint return. So I think we're going to go into, let's look in the volunteer manual, page 126. Oh, wrong document. Okay. Okay, the qualifying child test for the earned income credit. So the qualifying child for the earned income tax credit, who may or may not be the taxpayer's dependent on the tax return itself. The qualifying child must be under age 19 and younger than the taxpayer, or under age 24, younger than the taxpayer, and a full-time student for the last 5 months of the year, or any age of permanently and totally disabled for at the end of the tax year. Relationship. The child must be the taxpayer's child, sibling, or a descendant of these relatives. Residence. The child must have lived with the taxpayer in the U.S. for more than half of the year, with exceptions for temporary absences. Only the custodial parent may claim the earned income tax credit. If the child qualifies more than one person for the earned income tax credit, see the tiebreaker rules on page 66. If another person has erroneously filed claiming the taxpayer's qualifying child, prepare a paper return using the qualifying child. The IRS will use the tiebreaker rules to determine which person receives the earned income tax credit for the child. If you find yourself in that situation, your best bet is to ask the tax site manager for assistance because this situation is going to require a little bit of uh, tax expertise and finesse and grace when navigating the conversation with the taxpayer, especially when we're talking about such a high impact credit. Joint return, the child cannot be filing a tax return married filing jointly unless filing only to claim a refund of tax withheld. This means that the qualifying child for the earned income tax credit, if they're married, they cannot be filing their own married filing joint tax return unless the only reason they're filing it is to get um, taxes that were withheld from their paychecks refunded because they didn't actually owe that tax. Okay. Earned income tax credit rules with no qualifying child. So the taxpayer must meet the rules for everyone and they must be at least age 25 and under age 65 by the end of the tax year. This one can be a little surprising when you see somebody who's filing single, for example, and you look at their income and you're expecting to see the earned income tax credit and you don't see it. A lot of times it's because they're under age 25. So like a 23-year-old, for example, would never qualify. A 23-year-old with no qualifying child would never get the earned income tax credit because they're too young. And somebody over 65 also doesn't get it. There are income limits too, which are found on page 125. Okay, let's talk about child tax credits. We got a heads up here, order swap. In the manual, we have the federal and Minnesota credits are grouped separately. That's because the child tax credits, we have both federal child tax credits and state Minnesota tax credits, child tax credits. In this training, we're going to lump them together, talk about the federal and Minnesota credits, grouping them by type, but in the manual, they're separated, all the federal portions in one section and the Minnesota credit is in another section. And for example, the federal and Minnesota versions of the child tax credit are together in this training. Okay, the federal child tax credit first. So we're talking federal here, not state. The federal child tax credit, most families with children will qualify. It's a non-refundable credit. So remember, non-refundable means it can reduce the tax liability down to zero, but not past zero. Non-refundable credit of up to $2,200 per child. Eligible children follow the qualifying child dependency rules, plus child must be under age 17 and the child must have a social security number. Qualifying child dependency rules, remember, think back to basic B when we talked about first about how to qualify it, how to make somebody a qualifying person for a dependent, either the qualifying child or qualifying relative. That's the qualifying child we're talking about. So same rules plus under age 17 and must have social security number. The additional child tax credit is a refundable credit equal to the unused portion of the child tax credit. And this maximum is $1,700 per child and it's refundable. So if we go below $0 of tax liability, that negative value gets paid out. So who qualifies? Taxpayers with more than $2,500 of taxable earned income and at least one qualifying child, or taxpayers with three or more children, regardless of income. The nice thing about these credits as well, similar to the earned income tax credit, is that TaxSlayer does these calculations for you. So don't worry about trying to calculate these on your own. TaxSlayer does all the math for you. New for tax year 2025. Social Security numbers are required for the taxpayer or spouse if married filing jointly. So an ITIN, a customer with an ITIN, cannot claim the federal child tax credit or the additional child tax credit. ITIN filers can claim the credit for other dependents and the federal child tax credit and additional child tax credit for 2024 tax year and earlier, and the Minnesota child tax credits for any year. So that might be a difference if you work with a customer preparing a tax return for 2025 and they have ITINs and not social security numbers. They may have qualified for the federal child tax credit and the additional child tax credit in the past, and now they don't. The credit for other dependents. This is another federal credit. This is available for dependents who don't qualify for the child tax credit. It's a non-refundable credit of up to $500 per qualifying dependent. Eligibility rules follow dependency rules. And additional rule, the dependents must live in the US. Again, when we say dependency rules, we're talking about a qualifying person for a dependent, either as a qualifying child or as a qualifying relative, which we learned about in Basic B. Keyword here, available for dependents who don't qualify for the child tax credit. So if somebody does qualify for the child tax credit, they're not going to qualify for the credit for other dependents. Before we go, I just want to mention here you don't need to be an expert on every tax credit that we're going to talk about tonight. Your goal is to recognize the names and the themes so you know what to look for and then be able to look it up in your tax manual. As I mentioned a little earlier, even the most experienced volunteers and tax site managers use the volunteer tax manual in every shift because you can't remember every rule for every tax credit. So your goal tonight is to remember the names of these credits and some of the high-level features so that you know to look them up in your volunteer tax manual when it's relevant. Okay, we're moving on to Minnesota here. Notice that our icon at the top changed from the USA icon to the Minnesota icon. We're talking about Minnesota Child and Working Family Credits, also called MNCWFC. So, facts about child and working family credits. It's a refundable credit. It's the most generous state child tax credit in the nation. So Minnesota is a good place for people with children who are working to live in terms of state child tax credits. It's calculated automatically. Yay! It's lovely when TaxSlayer does this for us. It can be a huge refund amount, very significant. So it's important that you understand why a taxpayer is receiving it or not. So here are the rules for everyone. Everybody must be a full or part year resident of Minnesota, not a dependent of another person, So that means if there are qualifying children for this credit, they're not the dependents of anybody else, i.e. a different person's tax return. They must have less than 1,000 or $11,950 of investment income and cannot file married filing separately. One thing you learned in Basic B about filing status is that married filing separate is the least advantageous filing status. It generally results in the lowest refunds, and this is one of many examples why somebody who files married filing separate cannot claim the child and working family credit no matter what. The amount of the Minnesota Child and Working Family Credit is based on dependents. So either one, if no qualifying child, two, if there are children under 18, or three, if qualifying older children. You'll often see a combination of two and three. So number one, if there's no qualifying child, so somebody who does not have a qualifying child for this credit, the maximum credit that they can receive is $379. And it can be less, but not more. Requirements, if there's no qualifying child, the taxpayer must be between the ages of 19 and 64, and they must have earned income. Similar to the earned income tax credit, the dollar amount of this credit phases in at lower income and phases out at higher incomes. So think about that plateau or that kind of pyramid with the flat top that we saw for the earned income tax credit. Same concept for this credit. As income increases, the dollar amount of this credit increases until it reaches a point, the maximum. Then as the income continues to increase, the dollar amount of the credit decreases. So number two, if there are children under 18, the taxpayers can claim up to $1,750 per child who's under age 18. There's no limit to the number of children under 18 the taxpayer can claim. And there's no income requirements. Even if their adjusted gross income is $0, they can still claim this credit. The credit phases out gradually at a certain income. The Minnesota Child and Working Family Credit has its own qualifying child rules on page 157. And number three, the situation if the qualifying child is over 18. So the older children must be either a full-time student, age 18 to 23. Sorry, I said over 18. I guess it's technically over 17 or 18 and older. Specifically 18 to 23. So they can be a full-time student, ages 18 to 23, or over 17, so no maximum age, and totally and permanently disabled. The credit phases out gradually at a certain income. So here's an example with one older qualifying child, $1,379 is the maximum credit. Two qualifying older children, $2,649 is the maximum credit. Limit of three qualifying older children. So unlike the qualifying children under 18, which has no limit to the number of children under 18, there is a limit to the number of children over 17, and that is three. So that would give a maximum credit of $3,089. Adding up the child and working family credit. Let's look at an example of Charlie's tax situation. So Charlie's filing head of household. All income is from a job, $28,950. Charlie has twins, age 13, plus one child in college, age 22. So we see two children here in situation number two, being under age 18, and one child, situation number three, over age 17. So we have $3,500 starting with. This is $1,750 multiplied by two children under age 18 for the Minnesota Child Tax Credit. And then we add 1,379, the working family credit for one qualifying older child, which results in total of $4,839 total child and working family credit. Look at this number, $4,839 compared to Charlie's income. And these numbers aren't just made up, they're pulled from realistic situations. So that's why I want to stress is that these credits are really important. Choosing for next year, advanced child tax credit payments. So this is um, an option that customers have. They, when they file their tax return, they'll get the child tax credit, the state child tax credit that they earned from tax year 2025 when they file the tax return in the next few months. They have the option at the same time to designate advance payments of their child tax credit that they'll earn in 2026, that they otherwise would get paid out in early 2027 when they file their 2026 tax return. Um, so they can choose to receive some of, not all of it, but some of the next year's child tax credit early in advance payment. The payments will be half of this year's child tax credit amount in three equal payments sent in August, October, and December. This is intended to give people a financial boost throughout the year rather than making them wait until like February, March, April of 2027 for what they earned in 20 for what they're due for 2026. It's a good option for customers whose income and dependents remain consistent from year to year. It's not a good option for families who receive SNAP benefits because SNAP benefits are based on income, and an advance payment of this tax credit can reduce unintentionally the SNAP benefits. So this was new last year, I think, or maybe 2 years ago. I don't remember exactly. It was a little confusing for customers, so we have some new forms to help navigate the situation. And I think you'll find both of these in the training website, prepareandprosper.moodlecloud.com, which you can link to from Prepare and Prosper's website. Just click on the volunteer resources. So if they do want the advance payment of what they're earning now in 2026, um, they fill out this form, which we keep, which basically certifies that they're making an informed decision to get those advance payments. And then we give them this copy that explains what the payment amounts are going to be and some more information about the advance payments. The super important part here is the reconciliation. So let's say they decide to get, in addition to getting the refund of what they're due for tax year 2025, when they file their 2026 tax return in the next few months, let's say they do opt in for the advance payment of what they're earning in 2026 and otherwise wouldn't get paid until they file the tax return in early 2027. If their income changes significantly in 2026, if it increases and they're due less of a credit, they're going to have to pay that difference back. Like what they got paid in advance but weren't actually due. It's a reconciliation process when they file the next year's tax return. So reconciling from previous year, advanced child tax credit payments. We will see this year as well because last year when they filed in 2025, when they filed their 2024 tax returns, they had the option to receive advance payments in late 2025 for what they otherwise wouldn't get until they filed the 2025 tax return in early 2026. So if they did last year, a year ago, if they chose to do advance payments, we need to do a reconciliation process. The taxpayers who did choose the advance payments in 2025, so 1 year ago, have received a letter or will have received a letter from Minnesota Revenue. That letter has the values needed that we need to reconcile the payments. TaxSlayer will calculate the remaining amount of their 2025 Minnesota child tax credit on Schedule M1C WFC. This is not going to be a simple process, so watch for a tax tip on this soon. Tax tips are documented tips for common situations that can be confusing or tricky that our training department pushes out through the year to help tax preparers and volunteers and staff navigate these situations. So the bottom line here is if somebody opted in for advance payments in 2025, when we do the reconciliation in 2026, if they got paid too much in advance, they're going to have to pay some of it back through their tax return, meaning a reduced refund. Okay, child and dependent care credit. This is a we have the federal child and dependent care credit. This is a non-refundable federal credit for expenses paid for child care or adult daycare. They must have a qualifying person, so a child under age 13 who is claimed as a dependent, either as a qualifying child or as a qualifying relative, or a person who is physically or mentally incapable of self-care. The dependent care credits qualifying expenses. So these will be expenses paid by the taxpayer or spouse to work or to look for work, such as attending job-related, um, like a uh, like a hiring kind of event or going to interviews. And so here's some examples: daycare programs for a qualifying person, nursery school or preschool for children below level of kindergarten qualifies. Day camp qualifies and overnight camp does not qualify. A not common situation, report employer dependent care benefits on Form W-2. Include amounts on the dependent care form to show benefits were used to pay for care. These amounts do not qualify a taxpayer for the credit. You might see this, but it's really not that common. If you do, just look in your volunteer manual, page 118. The dependent care credit, the qualifying provider. Most child care providers offer a statement listing the amount paid, the EIN, that's the employer identification number or federal tax ID number, and address. Individual providers sometimes offer their social security number if they don't have a business, for example, set up with an EIN, a federal tax ID number. Payments cannot be made to a taxpayer's dependent. So if the person who is providing the child care is also that taxpayer's dependent, nope, doesn't qualify. But if um, if the payment is to the taxpayer's child, and that child is 19 or older by the end of the tax year, and not the taxpayer's dependent on that taxpayer's tax return, then we're good. That we can use those expenses for the dependent care credit. Switching gears to Minnesota here, we have the Minnesota Dependent Care Credit. So this credit is refundable. The rules for the qualifying person and provider match the federal definitions. So the same definitions for qualifying person, so who's receiving the child care, and provider, who's providing the child care. Same requirements for the Minnesota credit as we just saw in the federal credit. There is a special Minnesota rule for this Minnesota credit, and that is parents with a child born in 2025. If the child was born in 2025, they get the maximum credit for um, the Minnesota Dependent Care Credit, even if they had no child care expenses. So that's kind of neat.
Is that for that one child or all children?
So the credit, it's one credit, regardless of the number of children. The dollar amount of the credit can vary by the number of children. So if they have one child born in 2025, they're going to get the maximum possible refund, regardless of the number of children, or maximum credit, regardless of the number of children.
Okay, thank you.
You're welcome.
Mike, we have a question in the chat from a moment or two ago that I missed.
Oh, okay.
They say if they opted for advance payments last year, how
Yep.
do we handle it?
So if they opted for advance payments of the advanced child tax credit, we do this reconciliation process um, right here. So these taxpayers will have received a letter from Minnesota Revenue, and we'll use the information from that letter, enter it in TaxSlayer. TaxSlayer will do the calculations. We don't have a lot of details on the exact process right now, so there will be a tax tip on this coming soon. Okay, we got Tina Parker. On page 3 of the IRS intake sheet, Tina marked that she paid for dependent care. What's our next step? Let's take a look. So the IRS intake sheet, page 1, 2, 3. Did she pay Any of these expenses? Child and dependent care. Okay. What should we do when we see that the customer, in this case Tina, marked an X here for child and dependent care credit? Feel free to type in the chat or just unmute yourself. And just throw out ideas. We're not expecting to be the experts at this point. Ask for documentation from the provider. Yes, definitely. So we're going to ask for documentation of the expenses. What else might we do? I would probably open the volunteer tax manual and I would look in the table of contents here for credits. Um, where am I looking here? The child tax credits. We'd be looking for the child dependent care credits. We'd be looking for child credit for dependence, credit for child independent care. We'd start looking at these pages in the volunteer tax manual and walking through them and seeing how they relate to the customer situation. So looking at the documentation and starting to go through the documentation in the manual to see what the customer might qualify for. Alrighty, it is time for a 10-minute break. Let's continue. We're going to talk about Minnesota renters credit. If you remember from the outline slide, the slide that showed the outline of this training course tonight, this was the one that was in really bold and big letters because it's so important and very, very common. So let's talk about Minnesota renters credit. We're talking specifically right now about people who rent an apartment or a home. They rent their lodging in Minnesota, not homeowners. That is a separate concept. So to qualify for the renter's credit, taxpayers may be eligible for a credit of up to $2,720 if that renter lived in a rental unit in 2025, had income under a certain level, and paid part or all of the rent with their own funds. Every renter receives this form from their landlord called the Certificate of Rent Paid, or CRP. This shows basic property information and rent paid. The property owners must issue this form by January 31st. Spoiler alert, some of them don't, but there are workarounds and it's really uncommon that they don't. Rent is split equally between roommates regardless of actual amount paid by each renter. This point is super important because it comes up from time to time when you have two or more adults living in the same apartment or rental property and they don't all pay the exact same amount each month. Maybe one pays more than the other because they have the bigger bedroom or something or whatever reason. Each adult is going to receive this form from the landlord with the exact same amount of rent paid listed here. And that's the total rent paid for all of them over the entire year divided by the number of adults renting, regardless of what each of them actually paid. And that's the way the law is written. And that's how the credit is calculated. So if you have two adults and they're not paying equal amounts of rent, one of them gets a great deal, one of them gets not so great of a deal in terms of the Minnesota renters credit. Missing CRPs. So when somebody doesn't have the form, we just looked at the form that shows how much rent they paid in that tax year. Customers should have all their CRPs before filing their taxes. They often have more than one CRP. For example, if they move from one place to another during the year, they're going to get a CRP from each landlord. If they forgot their form at home, they should leave and come back later or have someone text a photo of that form to them. Please, please, please talk to your tax site manager before you advise a customer to leave and come back. We certainly do that and we do it fairly often, but Some shifts are not a good fit for that, like if we're short-staffed or something. When somebody says I live 10 minutes away, it's often they actually live 20 minutes away, and then they have to look for it. By the time they get back, we're in a really difficult position. So please, please, please talk to your tax site manager if somebody is missing any of their documents, and then you and the tax site manager can figure out what the best way to proceed is. A lot of times what we do as well is we prepare the rest of the tax return except for this renter's portion and have them return on a different date with that missing document, and then we can quick finish the process then. That's another option. But just talk to your tax site manager. There are a lot of solutions available. It's not the end of the world if someone forgot their form at home. If they haven't received the CRP form yet from their landlord, they need to go to the landlord and ask for it. They need to make a reasonable attempt to get the CRP from the landlord. So not just, I don't think the landlord wants to give it to me. They need to actually try. If the landlord or owner refuses to provide the CRP, then the taxpayer can request a rent paid affidavit from the state. We can help them with the new rent paid affidavit handout. In this situation, the taxpayer basically files an affidavit with the state of Minnesota saying, this is how much I paid in rent. And even though I don't have proof of it because the landlord won't give me the CRP, and then they can still get their credit, the renter's credit that way. It's just a little more of a hassle. Multiple CRPs and overlapping dates. You're going to see this fairly often because, of course, people move throughout their lives. So here's an example of a customer named Terry. Terry has two CRPs. CRP1 is from January 1st to April 30th. On that CRP1, we see total rent paid of $2,400. CRP2 is from April 26th to December 31st. And CRP2's total rent paid was $4,800. Notice here we have 5 overlapping dates: April 26th, 27th, 28th, 29th, and 30th. That's really common when people move into the new apartment a few days before they leave the old apartment and have a few days of overlap to move all their stuff from the old place to the new place. We do have detailed instructions on page 168 of the volunteer manual. Here's a quick example of how this could look. Prorating for April, we have $600 per month divided by 30 days in April. That's $20 per day. 5 overlapping days multiplied by $20 per day is $100. We look at the second column here, the rent used to calculate the refund. Rent used from CRP, $2,400, the full amount. The rent used from CRP2 is $4,700. We subtracted this $100 from CRP2 to account for that overlap. So basically, the point here is when you have overlapping dates, you need to figure out how many days of overlap there are, calculate what the daily rent is for each, and then figure out which one is the better deal. So basically, the one they paid more rent at for those overlapping days is the one that we want to include in this calculation. And that's because this credit basically works like the higher the rent and the lower the income, maximizes the refund. Where you can find these answers about rent, where can you find these answers about renters? So what should you do if a married couple receives 2 CRPs with half of the rent paid on each? Does anybody know the answer? And if you do, where did you find the answer? Hint, it's in our documentation. Okay, I see 168 combine. Alrighty, let's look at the volunteer manual very quickly. We see on page 168, these are common renter situations. So what do we do when the married couple receives 2 CRPs with half the rent paid on each and they're filing joint, married filing joint? We combine them, we add them together and enter 1 CRP for that joint tax return. And what do we do if the renter has $0 of federal adjusted gross income? All right, we see
I
an answer
think
here.
we can add like other income of $1.
Exactly. Yep. Here is on page 169 of the volunteer manual. Many Prepare and Prosper customers have zero federal AGI, but they still qualify for the renter's credit. In this case, we are going to enter $1 of other income in the federal tax return, force the federal adjusted gross income to calculate as $1, and that allows them to claim the renter's credit. So again, the answers here, number one, if a married couple receives two CRPs and each one shows half the rent paid and they're filing a married filing joint tax return, we combine both CRPs into one CRP entry in TaxSlayer. And what should you do if the renter has $0 of federal AGI? We enter $1 of other income in order to e-file the return with this description to e-file state. Stan mentioned this happened quite a bit in my experience. Yes, we do see both these situations quite often. Looks like there's a question too. In case one of the roommates paid all year and the other guy moved in and joined in half years, did the landlord send CRP equally for both? That's a really good question. And I don't know the answer.
Mike, doesn't it depend on the landlord? Because some will do it exactly how it is, and some will just divide the total in half.
You could very possibly be right. And hi, Dolores. I didn't realize you were in this training. Fun fact, Dolores and I have known each other for a long time. And we also live across the street from each other. Anyway, let's go with what Dolores said because I don't know the answer. Will you repeat that again, Dolores?
I said I have seen where some landlords just give them equal what they paid, and some of them just add it together and divide it in half, regardless of what was paid.
Okay. So in Dolores's experience, it could go either way. They could, the landlord might issue for each CRP the amount that each person actually paid, or just add up the total rent for the year and divide by two in the case of two roommates. Okay. If rent is greater than income, we have to provide information on how the customer paid their rent. Enter each type of non-taxable income up to the amount of rent. Look for a tax tip on this early in the season. This happens sometimes, like if people are unemployed for a significant part of the year or choosing not to work, but they still have money to pay the rent. The most common way we see this is when people have some savings and they use their savings to pay for the rent. And so the rent they pay throughout the year is less than their income throughout the year. And we just end up entering a note in TaxSlayer to explain that they used their savings to pay for the rent. Another situation might be is if they have like a family member helping to support them and the family member is giving them some money to help pay the rent. Again, this is only when the rent paid in the year is higher than their income for that year. There will be a tax tip on this early in the season. Okay, TaxSlayer time. Together, let's enter the customer's CRP. The step-by-step directions are in your manual on page 170. If you have a setup where you can both watch me do this and navigate through TaxSlayer on your own at the same time, feel free to do so. Otherwise, you can just watch me as I do this and then practice on your own later. So the first thing I'm going to do is, if we go to the volunteer resources in the training site, remember this is, and then basic tax training. Here's where we find Tina Parker's documentation. I already have it saved to my computer. Whoops. Okay. And we're going to go into TaxSlayer Practice Lab, which you can also link to from Prepare and Prosper's website. Remember, when you go to the Practice Lab, you always enter this generic password in capital letters, Train Pro Web. Then you can sign in with the username and password that you created for a TaxSlayer Practice Lab. I'm going to go to the practice area. Remember, we are working in tax year 2024, so I need to change from 2025 to 2024. for our training demonstrations. We already started Tina Parker's tax return, so I go to Client Search. And here she is, Tina Parker. So I'll select Tina Parker. And we're going to enter her certificate of rent paid. Okay, I am in the tax return. I like to click this push pin here to keep the navigation open. The renter's credit is a state credit. So we're going to go to the state section. And we see here Minnesota. Now this is a little confusing. We have Minnesota's property tax refund. This is where homeowners, people who own their home, can get a portion of the property taxes they paid refunded. We're talking about the renter's credit right now. So we're not going to the property tax refund. We're going into the Minnesota tax return itself by clicking the pencil icon. It wants to know what county the taxpayer lives in. We already entered this in the basic information during basic B. The county's Hennepin. And we're going to go to credits because the renter's credit is a state-specific tax credit. And we find right here, renter's credit, Schedule M1 rent. Okay, is the taxpayer or spouse disabled? We saw on the intake paperwork, and I believe in our documentation of the interview that no, not disabled. Now this section, you'll find more information on the volunteer manual. This is really, these two lines are very uncommon. This is what we just talked about where we enter an explanation if the rent paid is higher than the income for the year. That's not relevant to Tina's situation because Tina did pay less in rent than she had in income in the year we're looking at. So we're going to enter the form Minnesota CRP that Tina received. This form, right? Where did I put it? Oh gosh, where did I put it? Right here. Okay. So the first thing I'm going to do is complete the renter's information. Enter the beginning date of rental. We got the date right here, 1/1/2024, rented from. Okay, and the ending date of the rental right here, 12/31/2024. Enter the number of units on the property. Right here, number of units on this property is 16. Electronic certificate number. That one is right up here, 01597 51168. Enter the number of adults living in the rental property. Count married couple is 2. Total adults living in the unit is 1. Is the renter name and address on the CRP the same as the name and address on the federal return? Let's look. 2705 DuPont Avenue South, Unit 10, 55408. 2705 DuPont Avenue South, Apartment 10, 55408. So yes, which means we don't need to re-enter it on the CRP. Okay, we'll continue. Now we're going to complete the owner's information. Is the owner an individual or business? Go back to the CRP. The property owner here is Cecily Arnold. So we can tell that this is a person versus a business by the name. We can always ask as well. So we're going to say individual. Individual owner's first name was Cecily, I think. Yep, no middle initial. We'll skip over middle initial. Arnold, the last name. Is the owner's address located in a foreign country? Cecily Arnold's address is 4348 Aldrich Avenue South, Minneapolis. So no, not in a foreign country. Enter the owner's address. 4348 Aldrich Avenue South. 55409. Minneapolis, Minnesota is populated automatically. Enter the owner's phone number. Do not enter dashes, only digits. So don't worry about the parentheses or dashes, just enter the 10 numbers. And her phone number is 990-656-3334. Enter the property ID number. Here it is. 3302 9244 10147. Sometimes you'll see this like very wrong or blank because the landlord doesn't understand what that means. Property ID, our parcel numbers are public information. We can look them up on property tax records. So if the taxpayer's CRP like has a wrong value here or it's blank, just ask your tax site manager for assistance because we can look up that property ID number. Property county, I don't know. Oh, right here, Hennepin. Hennepin. Is the owner a nursing home? We look for an X if the property is a nursing home. No. Nope. Is the owner an intermediate care facility? No. Is the owner an adult foster care facility? No. Now, why these are not in the same order as we see on the CRP, I don't know. Is the owner an assisted living facility? No. Enter the amount of rent paid to the owner, if any, paid by welfare, JMC, or Medicaid. We don't have anything listed. I don't think we're working in the 2024 software right now. I think this is gone from 2025. Enter the amount of rent paid to the owner, if any, paid by Minnesota Housing Support, formerly GRH. This question was changed on the form. It doesn't list an amount anymore. Oh, you know what? I think this one right here, paid by medical assistance, corresponds to this question right here. Welfare or Medicaid. Enter the amount paid by Minnesota Housing Support. We wouldn't see an amount anymore. We just see the box checked if there is, and if any of it was paid by Minnesota Housing Support, and then we'd look in our volunteer manual for what to do in that situation. So the most important line right here, line 1, enter the amount of rent paid, which is this line 1 right here. Renter's share of rent paid, $11,940. Was any part of rent paid for a mobile home? That one. No. Was any part of rent paid for mobile home lot? No. And caretaker rent reduction. Rent reduction for caretaker, 0. You could enter 0 here, or you just leave it blank. I'm just going to leave it blank. Continue. Okay, we have entered the CRP. Now, the very non-intuitive part here is after you enter the CRP, you may have noticed that these buttons used to say begin, and then after we enter data, now they say edit. We went to 2 different screens, one to enter the renter's information, and one to enter the owner's information, plus the amount of rent paid. These changed from begin to edit, which means we filled them out. You'd think you'd see like some kind of continue or save button here, but there isn't. We go back. But it's saved, don't worry. And we go back again. And then we can go to continue. Oh my. Yeah, okay, never mind. Sorry. I confused myself for a second there. So we were in the credits. We went to the renter's credit. I was expecting to see, maybe we don't see a dollar value here. Here's where we can go back into the renter's credit if we need to revise anything, like change any of our entries. We can go back to these two screens we entered data in. So anyway, we're done here. We're going to click back until we see continue, then back, then continue. Okay, we can exit the Minnesota return. And I think the next step in this exercise is,
Oh, sorry, Mike.
yeah,
I missed the part where you actually entered the amount of rent.
Okay, I'll
Where
show
was
you.
that? Oh, thank you.
Yep. So we're clicking here on state section, entering the Minnesota tax return by clicking the pencil button. The county's Hennepin will continue and continue. We go to credits, the renter's credit. We click this ellipses here and click edit for the renter's credit to edit the renter's credit. Enter form Minnesota CRP received. So we click edit. This is a listing of each CRP. So if the taxpayer had multiple CRPs, like if they moved throughout the year, you could add a second form CRP by clicking this button. So this box right here represents the CRP that we just entered. We can click the ellipses and click edit. The first screen where we did the data entry was the renter's information, such as the date, the beginning and end dates of the rentals, the number of units on the property. I don't know why they call this the renter's information, but they do. And the second screen here was the owner's information, where we entered the name of the landlord or the owner, Cecily Arnold, and Cecily's address. It was right down here, line 1, enter the amount of rent paid, which we found right here on line 1 of the CRP, $11,940.
Perfect. Thank you.
You're welcome. So again, to exit the CRP, or the Minnesota Renters Credit and the Minnesota tax return, I don't click continue unless I see continue. I don't see continue or save, so I click back, back. Now I see continue, so I can click continue. I don't see continue here, so I click back. This becomes more intuitive the more you do it. Don't worry. I see continue, so I click continue. I'm at the main menu of the Minnesota return. I can exit the Minnesota return. And then, so we entered this customer CRP together, and the directions are also in page 170, step by step. There also is in the training documentation. So remember, I went to Prepare and Prosper's website and clicked on volunteer resources and then the training page, which brought me to prepareandprosper.moodlecloud.com. You'll see here, there already is a video of what I just did, entering the Tina Parker CRP. So you can watch Holly, the manager of the training department, do the exact same thing if you want later on by clicking on this video on session D, tax layer entry, Tina Parker CRP. Okay. We're going to move on now to Minnesota's education credits. So talking again about a Minnesota specific credit, more than one credit, there's the student loan credit and the K through 12 credit. The Minnesota student loan credit, we have a non-refundable credit of up to $500 or $1,000 if married filing jointly and both spouses qualify. This credit is calculated on the total student loan payments made for the year, both the principal and the interest, so the total payments throughout the year. There's a similar federal deduction, so not a credit, but a deduction. And that federal deduction for student loans is based only on the interest portion paid on the loan. So just keep in mind that the Minnesota credit, the student loan credit, is based on the entire total amount paid throughout the year, both principal and interest, and the federal deduction, which is not a credit, is based only on the interest paid. Does anybody want to remind us what the difference is between a credit and a deduction?
Credit or deduction comes off of your AGI, credit comes off of your amount owed.
Exactly. Thank you. So a deduction reduces your income, which is then multiplied by a percentage to determine how much tax you owe. And a credit is based after the amount of tax you owe is calculated, it reduces the amount of tax that you owe. We subtract the amount of tax that you owe. And a credit can be refundable or non-refundable. A non-refundable credit can reduce that tax liability down to zero, but not any further, and refundable can reduce it below zero, and that excess is paid as a refund. Okay. So the credit calculation for this Minnesota student loan credit, it requires the amount of the original loan. So this can sometimes be a little bit of a tricky situation to navigate in the tax clinic when the customer knows how much they paid throughout the year. That's usually pretty easy to find, and they get a form that shows that anyway. But it doesn't show the principal amount, so the original amount of the loan. And some of these loans can be pretty old and they don't always know, and we need to know that exact amount. Like I mentioned earlier, if the customer is ever missing any kind of information, like a form or some critical piece of information, such as the amount of the original loan for this credit, talk to your tax site manager and help figure out what the best way to navigate the situation is. What we never want to do is skip a credit or even a deduction because somebody's missing documentation that they otherwise can get. We have plenty of workarounds, ways to navigate around that situation and still get people their maximum refunds. Okay, the K through 12 education credit. Generally, anyone qualifies if they have a qualifying child in grades K through 12 at a public, private, or home school. It's a refundable credit of 75% of the qualifying school expenses, a maximum of $2,000 of expenses. This is one of the few credits that's not automatic. So one of the situations where you really get to shine with your tax knowledge and expertise and using the volunteer tax manual and asking your tax site manager, other volunteers for help when you're not sure about something to maximize the credit for our customers. So there are eligible expenses, and then there are expenses that are not so eligible, meaning not eligible at all. Expenses must be to improve or expand knowledge and skills in core subjects. Some expenses need a qualifying instructor. Only up to $400 of the credit can be used for computer software and hardware expenses. Well, it's actually $200 for the K through 12 credits, and additional $200 for the K through 12 subtraction. Provide the K through 12 flyer and envelope to demonstrate what can qualify. If we were in person right now, I'd show you what this envelope looks like, but I can't right now. At our tax sites, we have a flyer with information and envelopes that explain this credit, and the envelopes are designed for taxpayers to have one easy to remember place to store their receipts. So they can just bring that envelope of receipts in the next year when they file their tax returns, and then they won't lose the receipts because they're all together in that envelope. So just remember that we have the flyer and envelope at the tax site. K through 12 education credit and receipts. This is a highly audited credit, meaning Minnesota Department of Revenue often reaches out after people file their tax returns asking for documentation or proof of these expenses. So we don't need to necessarily have their receipts at the tax site or the tax clinic. If they bring them with, that is amazing because we can be really confident in what we're doing. But they must have access to the receipts, like they must know where the receipts are in their house, or maybe have electronic copies that they can print. Because if they get audited, they need to give copies of these receipts to the Minnesota Department of Revenue. So no receipts means no credit, but if they tell us that they have the receipts and they know the exact dollar amounts, we can take their word for it. Now, if you have a customer that says, I paid $203.05 for this eligible expense, and I know it because I have the receipt at home and I'm confident that this number is accurate, that's good enough. If they say, I paid $200 or $220 for this, maybe I bought it last year. No, we need something a little more certain than that. But we don't necessarily need to see the receipt itself if they are confident about the figure. And again, your tax site manager can help you navigate these situations if you're unsure. Remind taxpayers to keep the receipts for 2026, meaning the receipts that they're collecting right now, the expenses that they're incurring in 2026, these K through 12 education expenses, because they're going to need to know this information when they file their 2026 tax returns in 2027. So we're giving them a reminder to save receipts now to make life easier when you file your tax return a year from now. And Prepare and Prosper has envelopes to use, the same envelopes we talked about on this previous slide. And if somebody wants more than one envelope, feel free to give them more than one envelope. So the education subtraction is in addition to the education credit. Both of these are Minnesota. The education subtraction is less common and less helpful for Prepare and Prosper customers because instead of reducing the tax liability, it reduces the income that the Minnesota tax liability is calculated from, like a deduction on the federal tax return. So, the subtraction can be used for private school tuition. Important note here is that private school tuition does not qualify for the credit, but it does for the subtraction. We can use the subtraction for expenses that exceed $2,000 per child. Remember, the credit had a limit of $2,000 of expenses per child. So anything in excess of $2,000 per child, we can then move over to the subtraction. And the subtraction can be used for computer hardware and education software. Reminder, we just saw in one of the previous slides that only $200 for computer hardware and educational software can be used for the credit, and $200 can be used for the subtraction for a total of $400. Financial service, College Bound St. Paul. What is the program? This is for any baby born after January 1st, 2020, who is a St. Paul resident. So if you're volunteering at a site in St. Paul or more on the eastern side of the Twin Cities, this will be more relevant. If you're volunteering at the site in Bloomington, like where I work, it's rarely relevant because the baby needs to be a St. Paul resident. They get a free college savings account opened with $50. Money is added for things like doing your taxes at Prepare and Prosper. The goal here is to improve access to higher education. And while $50 does not seem like a lot over 18 years, that can add up to a lot more. Your role as preparers, it's good for you to know and watch for it. For example, if you're working with a customer and you look at their intake paperwork and you see that they live in St. Paul, this customer Tina lives in Minneapolis, but pretend they live in St. Paul and pretend they have a baby born after January 1st, 2020. That might, or hopefully will make you think, oh, College Bound St. Paul might be a good fit for this customer. So it's good for you to know and watch for it and know how to find information about it if it's relevant. And I know I've said this a million times, ask your tax site manager if you need assistance. Customers can get a $50 bonus for getting their taxes done at Prepare and Prosper. Our customer support volunteers, so one of the other volunteer roles at the tax site, should give customers a bonus card to fill out and mail in for that $50 bonus. Okay, we're going to do an activity. This is the PAR family K through 12 credit. Instead of a handout, we have a slide. So here's our situation. The Parr family, Helen and Bob Parr, are interested in claiming the Minnesota K through 12 education credit on their tax return. They meet the income levels to qualify. Their daughter, Violet, is a junior in high school. Their son, Dash, is currently 10 years old, and their son, Jack, is 1 year old. They have a shoebox for receipts with a list of all their expenses, and you will see people literally bring in shoeboxes full of receipts. That definitely happens. Not always for K through 12 expenses, sometimes for medical expenses and other stuff too. So the trope of a shoebox full of receipts for taxes, it's real. Not common, but it's real. Okay. Here are the Parr family's expenses. We're going to figure out which ones qualify for Minnesota's K through 12 education credit. And the way you're going to do that is by looking in your manual on page 162. So if you go to page 162 in your volunteer manual, you'll see qualifying expenses for the K through 12 education credit and subtraction. You'll see here the expense category, what qualifies, what does not qualify. If you follow this chart, you're going to find the answer to all these questions. So I'm going to leave this slide up and you can work through these situations. And in about, just looking at the training outline here to see where we are in the training. Okay, you can work on this until 8 o'clock. So you get 13 minutes. Figure out each of these expenses if it qualifies for the Minnesota K through 12 education credit or subtraction. So everybody can work until 8 o'clock. Okay, it is 8 o'clock. So let's look at the answers. For Violet Par, we have school supplies of $84, and that qualifies. Textbooks for AP Science and Math, $110, qualifies. Dance lessons at Arabesque Dance School, $650, qualifies. Saxophone rental and reeds, $67, qualifies. Band uniform rental, $50, does not qualify. Got Dash Par next. School supplies, $106, qualifies. Field trips to the Mill City Museum and Science Museum, $40, qualifies. Track shoes of $50, does not qualify. Young Runners of Minnesota Camp, $350, does not qualify. Jack Jack has Loving Arms Daycare, $13,260. This does not qualify for the Minnesota K through 12 education credit, but it qualifies for the Child Independent Care credit. And the Power Family expenses, the computer for homework of $550. We can do up to $200 qualified for the K through 12 education credit and another $200 for the K through 12 education subtraction. The internet for homework, $624, does not qualify. Does anybody have any questions on these? Any that we want to revisit to see why the answer is what it is?
Yeah, I have a question about how far do we go on the qualifying instructor?
Let's see here. Okay. So individual instruction, tutoring, and music or dance lessons taught by a qualifying instructor, see below. A qualifying instructor cannot be the child's sibling, parent, or grandparent, must meet at least one of the following requirements. Minnesota licensed teacher or directly supervised by Minnesota licensed teacher, teaches in an accredited private school or has a baccalaureate degree, is a member of the Minnesota Music Teachers Association. You know? That's a great question. Dance lessons at Arabesque Dance School. Taught by a qualifying instructor. I think in this situation, like if I were the tax site manager and this question came up, I probably would ask the customer, like, first I'd try to eliminate this, like, was the instructor the child's sibling, parent, or grandparent, to eliminate that immediately. And then I would probably go through these and try to figure out what we can reasonably ascertain or reasonably learn about the instruction at this school or from this instructor.
Yeah, I'm just thinking as a parent, like
Yeah, the
kid
parent's
has
not
music
necessarily going
lessons, and I have at a professional school, but I have no idea if that teacher meets those
to, right?
qualifications. Like that's never come up. It's not on the website. I have no idea without asking that instructor.
Yeah, depending on, so sometimes we end up in situations where it's a bit of a gray area, where it's like, exactly to your point, how hard do we push this? And I think like this kind of thing we'd have to handle on a case by case basis. And the tax site manager might even reach out to other leaders in the organization for guidance if we end up in a kind of situation where it's unclear if the instructor would meet the qualifications or not, and to what extent are we going to push the customer. Generally speaking, we we definitely will never prepare anything that we know is fraudulent. So we can eliminate that right away if the taxpayer knew that the instructor did not meet these requirements. But more than likely, they're just not going to know, and it might end up being a balance between what level of risk is the taxpayer comfortable with. Because while we do prepare the tax returns and we are diligent and um, we use the resources we have to arrive at the right conclusions, some situations we can't always know. And we might talk to the taxpayer about what level of risk they're comfortable with. So in this kind of example, if Minnesota Department of Commerce audited this credit and asked for the copy of the receipt or proof of the expense for a dance lesson, I don't know if they're also going to ask for proof of the instructor's eligibility or not. I think it's better to be safe than sorry. And so the in that kind of situation, it might be worth looking, like doing some internet researching to see if we can find an answer, or maybe even asking the customer to contact the institution and then come back at a future date once they have that information and we're sure. But I think we'd have to handle that on a case by case basis and look to the tax site manager for guidance on that. Sorry, I don't have a better answer.
No, it's a good enough one. It depends, and it's
Yeah.
complicated.
Okay, there's a question. Okay, dance lessons, we covered both of those. Okay, does a computer have to be used for only homework to qualify? I don't think it needs to be used only for homework, but it does need to be used for the education. So let's see. Computer hardware and educational software for use in a taxpayer's home. It doesn't specifically say here that it's used for homework, but I'm pretty sure this implies that um, it will be used at least to some extent for school and education related activities, such as like writing papers or doing online classwork. Whereas if they bought the computer specific, like 100% for non-school, that wouldn't qualify. Minnesota does have more guidelines that we could look up, but we won't tonight. But if we needed to, more guidance on exactly what these requirements might be. And I think in the vast majority of cases, like if if the taxpayer bought a computer and wants to claim it for this K through 12 education credit, then they're going to answer yes when you ask them, did did the children or students use it, at least a little bit um, for the education. It doesn't have to be 100% usage. And then there was, what did you say about the band uniform? Okay, so the band uniform, um, I'm looking here. School uniforms, um, including choir and band uniforms and graduation robes, do not qualify. Okay, let's move on. Federal education credits. We are nearing the end here. Federal education credits. So back to the federal tax return, education credits overview. We have the American Opportunity Credit and the Lifetime Learning Credits. We're talking about students in higher education here, so not kindergarten through 12th grade, but college and university. The two credits, American Opportunity Credit and Lifetime Learning Credit. The American Opportunity Credit is up to $2,500 per student. 40% of the credit may be refundable, so up to $1,000 of this credit can be a refundable credit, and the remaining 60% of the credit is non-refundable. Available for the first 4 years of college. So the tricky part here, it's not that they get to use it 4 years. Like if they're in college for 8 years, they can't use it the last 4 years, even if they didn't use it the first 4 years. They can use it or lose it the first 4 years of college. The lifetime learning credit is up to $2,000 per return, non-refundable, and available for an unlimited number of years. Generally speaking, what we see is each student uses the American Opportunity Credit for the first 4 years. And then if they have any more years of education, then they start using the lifetime learning credit. Who is eligible? Taxpayers claiming a student completing post-secondary education. Students completing post-secondary education who are filing their own tax returns and cannot be claimed as a dependent on someone else's tax return. The information is reported on Form 1098-T, at least most of the information. Most of the qualifying expenses are listed on Form 1098-T, such as payments received for tuition and related expenses, scholarships and grants, at least half-time student. These are the three big things we're looking for on this form. A couple points we would need to look at here. If the student is a dependent on their parents' tax return, then the student does not claim the education credits on their own tax return if they file their own tax return. Instead, their parents claim the education credits for the student who's a dependent. If the parents don't claim the student as a dependent, then the students can claim the credits on their own tax return as long as nobody else can claim them as a dependent on their tax return. If you were in the Basic BSEC training session that I led on Tuesday, you'll recall that I stopped and focused on a really important question on the IRS intake paperwork, asking, can anybody else claim you as a dependent? Not, is anybody else planning to or going to or choosing to claim you as a dependent? Simply, can they claim you as a dependent, whether they do claim you or not? So one situation here that can be a little tricky is when you have a student who could be claimed as a dependent on their parents' tax return, but aren't. In this case, nobody gets the education credits because the parents can't claim the education credits for the student if the student's not a dependent on the parents' tax return. And the students can't claim the education credits on their own tax return if their parents or anybody else can claim the student as a dependent, regardless of whether they choose to or not. So in that kind of situation, we often talk to, if the taxpayer is the student and the parent is not planning to claim them, we often talk to them about why it's a good idea for the parents to claim them. So the parents can get the education credits and hopefully share some of that money with the student. So the important point here is students claimed as a dependent cannot claim the credits, and students who can be claimed as a dependent, even if they're not, cannot get the credit. New this season, we have an American Opportunity Credit Calculator. So this is an online tool that will help calculate the American Opportunity Credit, which is the better of the two education credits. I don't believe that it's ready yet, though. Coming soon, there will be a self-paced training on the education credits. So education credits are a lot of information in themselves. And so we're not going to cover it tonight. The goal tonight for you is for you to know that there will be more online training coming soon, and that there are two federal credits for education, for higher education, the American Opportunity Credit and the Lifetime Learning Credit. There is more information in the volunteer manual. Other credits to talk about we have the Federal Retirement Savings Credit. This is a non-refundable credit of up to $1,000 or $2,000 if married filing joint. The credit equals a percentage of contributions to a retirement account, including traditional IRA or Roth IRA contributions and contributions to employer-sponsored plans such as 401k or 403b. The taxpayer must be age 18 or older and cannot be a full-time student. The nice thing about this credit is that there's documentation of contributions to retirement accounts such as IRAs or to an employer-sponsored plan. We'd see the contributions on the Form W-2 that the employer issues at the end of the year. Health insurance. TaxSlayer will ask if health insurance was from the marketplace for every customer. So we're talking about situations where individuals are not covered by a government-sponsored health plan, such as Medicare or Medicaid or medical assistance, Minnesota Care, but they aren't covered by their employer's health insurance or by their spouse's or parents' employer's health insurance. This is when people buy their own health insurance from a marketplace in Minnesota. The insurance marketplace is called MinSure. And generally speaking, they pay a monthly premium. They might get some assistance in the form of advanced premium tax credits to help pay for the premiums of that health insurance. If you've been watching the news lately, this has been a hot topic because a few years ago, there was some expanded credits to help people pay for their individual insurance plans, and those were not extended. And it's been a hot point between Republicans and Democrats in the federal legislature. There still are tax credits, but just not as much as there used to be. So people have seen really steep increases in premiums. So state health insurance programs, like I just mentioned, medical assistance and Minnesota Care, for example, are not marketplace coverage and do not require any forms. The easiest way to figure this out is that a taxpayer who did purchase insurance on the marketplace receives Form 1095-A from the marketplace. And that's the form that we need to do to figure out this credit. This is a very small portion of our customers overall. I can tell you, I see this a handful of times each tax season, and I look at a lot of tax returns. The reason we need this Form 1095-A is because if people did receive advanced payments of the tax credit to help offset their premiums, we need to do a reconciliation process. That way, if they didn't receive enough, like if they were actually due or entitled to more money in the form of tax credits, then they get that difference as a refund when they file a tax return. Or if they receive too much, that happens sometimes when people's income increases significantly in the year, then they have to repay the excess of what they didn't actually deserve or earn. So most must reconcile credits received to help pay for health insurance, the premium tax credit. MinSure coverage is available as a metal level plan. One question we often ask when people really aren't sure of what kind of insurance they had or if they bought it on the exchange, we ask, did you go to MinSure's website and choose a plan that includes bronze, silver, gold, or platinum in the name? That's a big key because that always bronze, silver, gold, or platinum in the name of the insurance plan always means it was purchased on the marketplace. The premium tax credit is an advanced tax topic. So if you're certified basic, you don't have to deal with it. You can learn more in the volunteer manual or publication 4012. So if you're certifying basic, which I assume most of you are, what you just need to know here is that this credit exists, that it's an advanced topic, and that if you have a customer with this topic, you can ask your tax site manager for assistance. And you don't have to do this yourself.
Okay,
Lots of
I have a
yes, go
question.
ahead.
So the insurance policies from like popular insurance companies like Blue Cross Blue Shield or Health Partners, those are considered marketplace?
It's considered marketplace if somebody went to MinSure's website and shopped for an individual health insurance plan from one of those companies, and the plan includes the words bronze, silver, gold, or platinum, and they purchased that health insurance plan on MNsure's website, and they pay a monthly premium.
Okay.
It's a
Thanks.
little complex,
Yeah.
but if you're certifying basic, you don't have to worry about it. And if you're certifying advanced for whatever reason, there's plenty of resources and people to help you. Okay, so lots of other credits, uncommon in tax clinics. We have the foreign tax credit. That's if somebody lives outside of the US for part of the year and they pay taxes to a foreign country, then the taxes they pay to the foreign country can be used to offset the taxes due to federal and state governments here. Very uncommon. Credit for taxes paid to another state. Um, so if somebody like pays taxes to Wisconsin and then they move to Minnesota, they can get a credit in Minnesota for the taxes they paid in Wisconsin. It reduces their taxes in Minnesota. Parents of stillborn children. This one's kind of awkward because you don't generally just don't ask people, did you have a stillborn child last year? But the Prepare and Prosper paperwork does ask that question. It's a common question of like, why are we asking that question? Because it's, really very personal and a little awkward. You'll see here, derp-a-derp-a-derp-a-der. It's on here somewhere. I must have just overlooked it here. Okay, hang on. Resident of Minnesota has been in experience. Any sexual. Okay. Experience is stillbirth. So on the Prepare and Prosper intake paperwork, there's this question under Minnesota tax information. Did any of the following situations apply to you or your spouse in 2025? Experience is stillbirth. Sometimes people are taken aback by this question, like, why are you asking? And the reason is that there's a Minnesota credit. So if somebody has a stillborn child, in that tax year, there's a tax credit for Minnesota. I don't remember off the top of my head how much it is, but it's in a volunteer manual, and they don't need to provide proof. It's an honor system kind of thing. Credit for past military service in Minnesota, a marriage credit in Minnesota, credit for attaining a master's degree in a teacher licensure field in Minnesota. Because these are uncommon in tax clinics and only rarely come up, we're not going to spend time on them tonight. You really should just know that they exist so that, for example, if someone mentions to you that they got a master's degree in a teacher licensure kind of field, you can think, oh, there's a credit for that. But again, this intake paperwork is going to screen for the vast majority, if not all of them. Okay, wrap up. So share your feedback with us. What worked for you? What do you wish we'd covered or spent more time on? On your phone, you can use this QR code or you can use the SurveyMonkey link, which I think Mary's also going to put in the chat. I just want to see if there's anything else I need
Yes,
to share
one
with you.
moment.
Okay, Mary will put this in the chat, so you don't need to scan that QR code. Your next steps after this training tonight, you will start working on your certification tests in publication 6744. This is a booklet that you get with your other training materials. It's the paper copies of the IRS certification test that you'll do online. And I strongly recommend, especially for your first year, that you spend the time doing the tests in this paper booklet because then it's much easier to navigate. You can flip pages and take your time. And then when you're done, then you can go online to do the certification test online and just click the answers that you've already circled in the book. It makes it so much easier than just going straight to online. But do what works for you. You'll attend Basic E next, finishing a return and M1 PR. And if you're scheduled for that on Monday, you'll see me again on Zoom. So thank you.